agenda for today's discussion is to how to approach the markets more from a behavioral perspective. And markets are external part. We will deal a little bit about our internal habits as to what we do and how it impacts our investments and the overall portfolio returns is important. So, we all do asset allocation. We do investments a little bit into equities, a little bit into debt within. We have traditional instruments, we have FDs, we have debt mutual funds. We do have in our mind thinking of buying real estate. That's a separate asset class. Many people have the habit of just investing in gold because traditionally the family has been doing so. So that is the safest. At least you can keep it, you can see it. It's the different feel you get. But many people have this habit of buying jewelry. Let me tell you, jewelry is a product that you use. It's not, it can be used as an investment, but that's not a right way to approach gold as an investment because, nobody wants to sell their jewelry for any other purpose. It's a mental defeat or something of that sort. So coming back to our discussion, so I gave an introduction about various asset classes. Now let me try and open my presentation. I hope the presentation is visible. It's called Investing in Uncertain Times. People are saying, oh, today the markets are very, very uncertain. What to do? Trust me on this. In the introduction, Mr. Ramalingam said that I have about 17 years of experience. Let me tell you, in 2004, January, when I entered the industry, financial services, the first presentation I made, the title was the same. Investing in uncertain times. That shows that it has always been uncertain when it comes to equity markets. Is there anything certain about investment? We will talk about this certainty, uncertainty, etc. for the first 5 minutes, then we'll proceed on to how it impacts us. Is there anything certain about investing? Many people will say yes. For instance, if I go to a simple fixed deposit, if I put say 1 lakh rupees or say 5 lakh rupees, any amount of money that you put, at the end of 3 years, I exactly know how much will this 1 lakh become. So I have a certainty about it. So certainty and safety are two different things. Safety is knowing that your money is not likely to go down, and certainty is the intention that we want to know exactly how much it's going to become. So it's slightly different. So FD gives you both, right? It gives you, that's what it's understood. It's supposed to be a safe product. It's supposed to give you that certainty. This is what it's going to become. Mutual funds, I can't use the word safety when it comes to mutual fund. We are not allowed to use that. But there are less volatile products like debt mutual fund, fixed income mutual funds. There also, there is uncertainty. We don't know exactly how much our money is going to become. So when you come to mutual funds, we have to take away this requirement that we need to know that exactly how much my money is going to become at the end of 3 or 5 years. And that characteristic or that feature is what going to reward you in the long term. One second. Yeah, so the message is, do not seek too much of certainty. There is some mistake in that. Embrace uncertainty. Do not seek certainty, embrace uncertainty. I've written embrace it. Quickly, there is some typo there. So can you avoid uncertainty? What is the price you will pay for avoiding uncertainty? I just want to bring out a quote which I recently read in a book. I'm forgetting the book name also. It says that a ship is safe or the safest in the harbor. A ship is always safe in its harbor, but is it what it is where it is meant to be? A ship is supposed to sail in the ocean and cover a lot of places. There are risks involved, but that's what a ship is made for. So I would like to associate a behavior among investors that if you keep all your money seeking certainty and safety, then that's not the right thing to do, because there is a price that you are actually paying a heavy price for that. Let me give you a data today. As of today, around 150 lakh crore 150 lakh crore worth of money is lying in FDs. I mean, that data is available on a weekly basis with RBI. So what is the total size of mutual fund industry? It's about 36 lakh crore. Out of that, equities are about 14, or maybe there are some hybrids which have some equity. So about 14 lakh crore. So 1/10 is the equity assets of mutual funds, and 10 times of that is the FDs. I mean, overall, as a whole, Indians have actually, uh, I don't know whether I can say they have gone wrong in their asset allocation, but they have been safety seeking and they have not been able to avoid this uncertainty. So that is one thing. So what is the whole objective of investing? The main objective of investing is to outperform inflation. We all know what is inflation. Inflation is the every year price rise that we see in our goods and services that we purchase. So last year, the price of 1 kg rice or a packet of bread was so much. This year, it is slightly higher. So that increase every year, year on year, is called the inflation. So on a yearly basis, the return that we generate need to, at a bare minimum, beat inflation. That is our overall objective. Today, the inflation is about 5.5%. What do you get in fixed income post tax is much lower. So again, we are not supposed to use word guarantees, etc. So what is guaranteed is that when you seek certainty, you are guaranteed to lose money on real terms as in adjusted for inflation. So what is the answer for this? Equities is the answer. So equities or stocks, but I can't do it on my own. There are problems. So that's why mutual funds comes into the picture, and there are ways to deal with this uncertainty. That's my main message of this entire presentation. How do we deal with this uncertainty, or we don't know what will happen tomorrow? Markets will go down. There are ways to deal with it, scientifically proven methods to deal with them. We cannot avoid them, we cannot eliminate them, but we can deal with them in a much better way, so as the impact of that uncertainty do not affect us negatively. A table I have shown here. Quickly, I'll just showcase that to you. 100 rupees invested for 25 years. Imagine 25 years is a long time, and many of the youngsters, I'm saying youngsters, even if you are a 35-year-old person or a 30-year-old person, you are still young. Above 40, then we are like approaching the middle age or whatever, and 50 above, then we are approaching retirement. But for a 35-year-old person, there is still a time frame of 25 years till retirement. Okay, so after retirement, what will happen? Our income stops, and we have to have enough corpus, and the income from that corpus should be able to take care of our expenses. Imagine, I've told you about inflation about 5-6% in India, or 7%, whatever it is. There is a bigger inflation which we don't factor into, which we don't consider, which is a lifestyle inflation. A generation ago, I mean, when I was a kid, I used to have one footwear, one for the school and one for the house. Today, my children have, I mean, I'm not boasting about my income levels or anything, but generally that is the case. I mean, the lifestyles have changed, and lifestyle inflation. We want to have a better lifestyle. For example, we want to have better phones, better cars, better house. You want to send your children to a better school. Many of you today who are the audience will have children, or planning to have children, or in the young, at some point in time, most of us will go through these life stages, and you have to plan for that retirement as well. So the table, if you see 100 rupees growing at 5% on the left side, 25 years of compounding, per annum return of 5%. It's just a mathematical computation. 100 grows to 339 at 5%. Today, you know what is the rates on fixed income products, and I'm on the right side. I'm changing that number from 5% to 10%. Look at the difference. End value from 339, it goes almost 3 times to 1083. Doubling of return end corpus, triples. So that is the impact of compounding in long time frames. Now you extrapolate this number, this for 25 years. If it was 35 years, imagine that is if somebody is starting a career in 22, 23, 24, 25 years of age, and there is 35 years of career left in you, and that is the time at which you should start saving and investing, so that at retirement, I mean, it's like unbelievably large number. I mean, to a great extent, I mean, arguably, as I've heard it from many people that it doesn't matter how much money you make. What matters more is where you invest, or what is your asset allocation, how much equities you have in your overall asset allocation. Now, why that? Because whether you will retire rich, I'm not saying poor or less rich, 339 versus 1083, depends upon where you invest. It doesn't depend upon what you make. I mean, what you make is 100 constant, but where you invest will, to a great extent, determine whether you will retire rich or poor. So it's important. Embracing uncertainty may be beneficial. I'm sorry for the headline. There is an error in that. Embracing. I'm saying it says embracing certainty. Sorry, uncertain. I mean, a child, when he or she is growing up, when she or 5 years or 6 years old, he or she doesn't know what that person will become. Whether it will be a doctor or a salaried employee or a business person or an astronaut, or these are the flashy careers. So uncertainty is part of our life. Tomorrow we don't know what will happen. I mean, but we have to deal with that. So why, when it comes to investment, we want to avoid uncertainty? Embrace it. So that's the main message. Now, is the market all the times unstructured, or is it a chaotic place? Anything suddenly happens tomorrow, Sensex becomes half, will that happen? What we say is that there is a method to this madness, and we go by a concept called market cycles. We all know, many of you today may not be from finance background. Many of you will be from some other educational background, software or medical or any particular profession. But we all would have heard about business cycles, economic cycle. Economy goes up and down, businesses go up and down. So does market. Markets also go through this up and down cycle. So I have, I don't know if I can write. Yeah, I can write. So if you see this line, the curvy line, let's assume that is a theoretical structure of the market. It keeps on going up and down. Suddenly it reaches a place called peak. Suddenly it reaches a place called bottom. And we have an average line in the middle. What we need to note at this point in time is that the average line is upward sloping, which means that the markets go, in a country like India, which is growing, markets also should grow in the long term. So that's what. So average line is what pulls the market from left or right or up and down towards the average. If it goes too much astray on the right side or the left side, it pulls. I mean, that's the role of the average. Averages are very powerful. We call it a mean reversion as a jargonistic term in the markets. Everything reverts to the mean. Is what we call. I mean, imagine. I always quote this example of a person. Imagine you are walking on a beach with a dog on a leash, and you walk. The man or anybody walks on a beach on a straight line, but the dog doesn't go on a straight line. It goes left and right and all the places, but it cannot go unlimited way on the right side or the left side. There is the leash that the man holds so that it does not run away. But if you observe the footprint of the man and the dog, I mean, the man will go like this, like this, like this, like this. The dog will go like this, like this, like this. So I'm just asking you to imagine this. But this is what happens with the market. So the markets go up and down, but the average, see, the average line is nothing but in stock market terms, you can say it is the economy, our country's businesses, and the business's profitability. So if the country is growing, we all know that India is actually, it is being labeled as the fastest growing country over the past few years, and COVID came and a lot of disruptions happened. And now also IMF last week has labeled India as the fastest growing country in the world. So we are lucky in the first place that we are part of this country, which is the fastest growing. So we should, I mean, pat ourselves on our back that, first of all, yes, we belong to a country, we should be confident. And what does it mean? If the country grows, economy grows, the businesses also will grow over a period of time, barring one or two exceptions here and there. On an average, the country economies grows and the businesses grows. It will reflect in the sales or revenues or the growth of the businesses, which should reflect over a period of time into the profits of the businesses. So top 100 companies, top 200 to 300, 500 companies in India, they have to grow in terms of their sales and profits. And that will, of course, reflect, because in the long term, the markets or the stock prices are slaves of the profits of the companies that are listed. So as long as we are in a country, we have to be, the base case assumption is that the stock markets are going up in the long term, but it will be subject to this ups and downs, which are based on various things. I mean, how uncertain? I mean, let me take you back 1.5 years back. Just COVID emerged. It was a huge problem for the entire humanity, and loss of lives and uncertainty on so many things. I mean, personally, I thought when the markets were going down, that was of less of a worry. The first worry was that this disease should not come to our family and myself. I mean, we are all selfish people. I mean, we all think about our family first. So that's not a wrong thing. So it's in the human nature to think like that. And we this disease should not come, then the markets. But how did the markets respond? The markets fell down sharply in a matter of few weeks. The Sensex, which was at 40 or 41,000, fell sharply to 26,000. I mean, imagine 37% fall in a matter of 2-3 weeks. At that time, I remember we used to write articles. We used to tell people that do not exit at this point in time. Please hold on to your investments. Please hold on to your SIPs. Please go by your asset allocation. Please listen to the expert. Don't give in to your emotions. I mean, many people have made losses. Oh, this is not for me. Okay, let's get out of equities in the first place. Many people even said how many years it will take for Sensex to touch the 40,000 mark. There were many newspaper articles that predicted if Sensex goes back, if this happens, Sensex will touch in 5 years 40,000. In 3 years, I mean, nobody even thought of a scenario when it will climb back before 3 years, because that was the heightened level of pessimism at that time. Now look at how the way market surprised us. I mean, in not only that it touched 40,000 in a few months, it touched 50,000. Many people were in disbelief. Oh, whatever happens, we want to exit. I mean, 50,000, let's exit. Come on, let's pack and go away. I mean, 55 also happened, 60 also happened, 62 also happened. Now, what I'm trying to get at is that the absolute levels of markets are not an indicator whether it is an expensive or a cheap market. 40,000, 50, it doesn't tell us anything, because for example, if you invest in a liquid or an FD, for example, an FD also goes up every day. I mean, mathematically, if you built in a per day interest, but FD also goes up on a day. It also touches an all-time high every day. So will you get worried about an FD touching an all-time high on an FD? Theoretically, that's what it happens. I mean, it doesn't go down at all, right? I mean, mathematically, I don't know about the penalties for early exiting FDs, but anytime you go, you get some interest. So theoretically, the FD also touches all time. So why worry when the equity markets touch an all time? There are other indicators that tell us whether the markets are expensive or not. We'll come to that. But going back to this diagram, this is the iron rule for the markets. At some point in time, the markets are at peak. At some point in time, the markets are at bottom. So what we should do with this after knowing this? Simple, right? So buy at the bottom, sell at the peak. That's what everybody wants to do. But that's not so easy. I mean, that's actually what we should avoid trying to do in a market. I mean, this defeats logic, right? But that's what we should do, because we don't know at what point in time we are at a bottom or at a peak. We don't know. For instance, when the markets fell last year from 40 to 26,000, it went through a stage at which it was 35,000, 33,000. So somebody got excited at 33,000. Oh, market has corrected 7,000 points. Let's put all the money. It would have corrected further, right? Similarly, when some markets touch 40, 45,000 on its way up, somebody gets excited. It's the peak. Let's sell everything. What happened now? So that's what I want to say, that buying at the bottom and selling at the peak, while sounds nice, that's not going to happen. So what do we aim for? We have to capture this average. That's all about. So capturing the average is all about capturing. I mean, investing in equities is all about capturing that average on a long term. I mean, let me tell you, in the last 40 years of Sensex, 1979 till now, 42 years, there is a 14 or a 15% per annum compounding in Sensex. I mean, isn't that good enough? Why we want to outperform? As an investor, there are active fund managers who are trying to do that. They try to pick up best, or they have a team, they have a research team, they lead the management of the businesses. That's their job. As investors, we want to capture this average. I'll tell you how to capture this average also. There are tools to do that. We'll come back to this. We'll revisit this. There is a clock, the grandfather clock also. I mean, symbolically, it represents that this particular pendulum that goes left and right. I mean, if it goes left, it has to come right. If it goes, it alternates, does that. So a market going down from, in terms of this valuations, does not get too much expensive. I mean, this is the cyclicality of the market. So that also tells that this is the behavior of the markets. We'll come back to this particular theoretical charting of the markets. Clear this. Yeah. This is the last 20 years per annum returns of Nifty 50. There are years when the market went down 36%. There are years in the market went up 74%, 67%, 81%. But if you draw a theoretical line, superimposing on these charts, I mean, this is the market cycle. I mean, we saw here the market cyclic in the theoretical terms, but this is actually happening. I mean, on a year-on-year basis, also the cyclicality is depicted. But what I'm trying to say is that for first-time investors who come into equities, after looking at returns, I mean, many people are making this mistake today, that 1 year returns on the markets is about 60 or 70 or 80% in many mutual funds. They go by the highest ranking as per the last 1 year returns. Oh, this is a great fund, let's go into that. The worst thing is that they come with the same expectation that the next 1 year will be similar to that. I mean, that's not going to happen. I can guarantee you that it's not going to happen. I mean, mutual fund people cannot use the word guarantee, but yeah, I can guarantee that the next 1-2 years will not produce the same return. You have to lower down your expectations. So let's assume there was this 1 year 74%, and let's assume a conversation between two people, the investor and the investment expert. The investor says, oh, you have given me 4 mutual funds, 2 of them are equity, 2 of them are debt, but the last 1 year I have invested in those 4 funds, and today, if I see the two equity funds have doubled, almost 74% return, why did you make me invest in those two debt funds? I mean, that's the most stupid thing that I could ever do. I mean, all my money would have doubled, right? So why did you make me put half the money in debt funds? So that's the reaction. That's typically called as the greed of investors. On the other hand, if you look at this a year like this or this, wherein the markets went down 36% on 25%, then what will happen? Then the customer will again complain, why did you make me invest in two equity funds? This is a bad product. It went down 36%. You should have made me invest all the products in debt, all the money in debt. So that's the kind of, that's fearful behavior. Either the markets will make you greedy or fearful, and vice versa, again and again. That's what happens. Um, that is our behavioral cycle. So as far as our behavioral cycle is concerned, we need to go through an emotionally stable journey when it comes to handling our own personal finances. So how do we do that? Now, the first place, there was this asset allocation that was done. So half into equity, half into debt. That was the initial case with which these investors react. But that is one thing, that is one weapon to deal with this uncertainty. Because I'm jumping here and there in terms of my slides, but I'm sorry about that. Oh my God, now I have to scroll through a lot of slides. Sorry about that. I'd like to introduce you to a gentleman called Harry Markowitz at this point in time. Harry Markowitz, I talked about asset allocation, putting 50 here, 50 there. So why that is important? Harry Markowitz is a Nobel Prize winner for his contribution to the world of finance. I think he got it long back, decades back. He's now 94 years old. He came up with this theory in the 1950s, or it became popular in 60s. Ever since, globally, all the MBA finance, on all the people who are the most supposedly most intelligent people in finance, they all learn and textbook the theories devised by him. This is the modern portfolio theory. So he is one of the best brains ever in the field of finance, and we are all thankful to him, because it's whatever is he told is now this. I mean, the kids learn that as part of their basic. So the most important thing is that in one of the interviews, he was asked by the interviewer, "Okay, sir. I mean, you are the most smartest person in the world of finance. I would like to know, what is your asset allocation? How much investment you have got in equity, debt?" So his answer to that was a surprise or a shock to most people. He said that I have invested 50% in debt, 50% in equity. And why? He was asked, why is that? So his verbatim, his quote was that, so what he said was that I invested 50 in equity, 50 in debt, because I visualized my grief if the stock market went way up and I wasn't in it, or it went way down and I was completely in it. So I'll repeat that. He's scared that if the stock market goes up sharply and he wasn't in it, or if it goes sharply down and he was completely invested in it. So that's why I do 50-50. Now, this is the best brain in the world of finance, acknowledging and accepting that he too is a human being, and he too is subject to emotions like greed and fear. And that's why I've split my portfolio into half-half. I mean, if he is, even he is emotionally susceptible to making mistakes in the stock market, then who are we? We are even normal people. So if he needs asset allocation, if asset allocation is a weapon for him, that is also a weapon for us to counter this. I mean, it doesn't change whatever happens in the market. It changes your outlook. Okay, markets have gone down, at least 50 in debt. Markets have gone up, at least 50 in equity. So that's how it needs. That's as simple as that. Oh, you will say, oh, you people are so smart, finance people, and you've done so many educational courses. This is a simple thing you are telling. yes, that's what we are telling. And if anybody tells some smarter solutions, please do not trust that person, because there is no scientific method or mathematical formula or a computer that can predict markets. It's also only thing that we can that governs is the profits of the company. If a company's profits grows, so its stock price have to grow. It cannot it cannot happen that a company's profit grows and the stock goes down. It can happen for some time, but it cannot. It's like a dog and the man. The dog man goes left and dog, to some extent it can go, but it cannot happen that forever it happens. So that will lead to a scenario a particular stock is too much undervalued or too much overvalued. If a stock becomes too much overvalued, people will jump onto it, sell that. People will at some point, people have to notice that the same thing happens vice versa and the overall market as well. So I told you about asset allocation. There are only two tools I will tell you. One is the asset allocation, and the other one is we'll come to that. Mhm. Yeah. Okay. Let me tell you. I mean, you've all heard of SIPs. What happens in an SIP is that you invest, say 10,000 rupees a month or 20,000 rupees a month in a particular equity fund, or split it into two equity funds, one large cap, one mid cap, and one small cap, or a flexi cap. So many categories of mutual funds are there. So you can ask your expert and they will guide you. Mr. Rabalingam can guide you as to where to invest. And what I'm trying to suggest is that when you do an SIP, the first installment, I mean, goes here, then here, 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 here. So every month an installment goes. So what happens is that you buy in low times also, peak also, bottom also. Essentially, you have captured the average line. You have entered the market at all points in time. So you have captured the market's average. And average, capturing the average is so powerful. So let me I'm trying to deviate because we have the luxury of time. I think we have about 1 hour more. So let me